You know about the federal capital gains exclusion, $250,000 if you are single, $500,000 if you are married filing jointly. Most sellers stop there and assume they are covered. But Connecticut has its own capital gains tax, and it catches Greenwich sellers off guard every single time. Today, I am walking you through exactly how capital gains taxes work when you sell your home in Connecticut, the federal layer, the state layer, and a special exemption for sellers over 65 that most people have never heard of. I am Charles Nedder, a realtor here in Greenwich, Connecticut, and I walk sellers through this conversation regularly, especially in a market where homes have appreciated significantly over the last 5 to 10 years. By the end of this video, you will understand how your gain is calculated, what Connecticut adds on top of the federal tax, and the one exemption that could save you a substantial amount. I want to be clear up front. I am not a tax advisor, and every seller's situation is different. But you need to understand the basics before you list so there are no surprises at closing. Let us start with how the gain is calculated, because a lot of sellers get this wrong. Your capital gain is not simply the difference between what you paid and what you sell for. It is your sale price minus your adjusted cost basis. Your cost basis starts with what you originally paid for the home. And then you add qualifying capital improvements, a new roof, a kitchen renovation, a pool, an addition, finished basement work. Those improvements increase your basis, which reduces your taxable gain. So if you bought your home for $1.5 million, put $300,000 into renovations over the years, and sell for $3.5 million, your gain is $1.7 million, not $2 million. Keeping records of your improvements matters. Every dollar of documented improvement reduces your taxable gain. Now the federal exclusion. If you have owned and lived in the home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain if you are single, or $500,000 if you are married filing jointly. In our example, a married couple with a $1.7 million gain would exclude $500,000, leaving $1.2 million in taxable gain at the federal level. That federal tax, at the long-term capital gains rate of 15 or 20% depending on your income, is what most sellers plan for. But here is what most sellers do not plan for. Connecticut taxes capital gains as ordinary income. There is no separate reduced rate for long-term gains at the state level. Your gain gets added to your other income for the year, and the combined total is taxed at Connecticut's progressive income tax rates, which go up to 6.99% at the top bracket. For a Greenwich seller with a $1.2 million taxable gain after the federal exclusion, that state tax bill can be significant. We are talking about potentially $70,000 to $80,000 or more in state income tax on top of what you owe federally. That is real money, and it is the number that shocks sellers when they sit down with their accountant after the sale. Now here's where it gets interesting, and this is the part almost nobody talks about. Connecticut has a special exemption for sellers who are 65 years of age or older. If you are 65 or over and you have owned and used the home as your principal residence for at least 5 of the last 8 years, you may qualify for a once-in-a-lifetime exemption from Connecticut capital gains tax on the sale. There is no dollar cap on this exemption. It applies to your state taxes only. Your federal obligation remains the same. But eliminating the state layer entirely on a large gain can save you tens of thousands of dollars. This is a once-in-a-lifetime benefit, so if you have multiple properties or are thinking about timing, it is worth having a conversation with your tax advisor about when and how to use it. Quick question, do you know what your actual gain would be if you sold today? Most sellers have a general sense of what their home is worth, but have never sat down and calculated the adjusted cost basis, the federal exclusion, and the state tax exposure. Getting that number before you list changes how you think about your pricing strategy, your timeline, and your net proceeds. So here's what I want you to take away. When you sell your home in Greenwich, you are not just dealing with federal capital gains tax. Connecticut adds its own layer, taxing your gain as ordinary income at rates up to 6.99%. The federal exclusion helps, but for homes that have appreciated significantly, the gain above that exclusion can create a meaningful state tax bill. And if you are 65 or older, there is a once-in-a-lifetime state exemption that could eliminate the Connecticut portion entirely. Talk to a tax professional before you list, not after. If you are thinking about selling a home you have owned for years in Greenwich, and want to understand what your numbers actually look like, reach out. Give me a call at 203-524-4303, and I will connect you with a tax professional who specializes in Connecticut real estate.